Today, let's take a look at what's hot and what's not on a seasonal basis for the month of January 2021. Before we do that, though, let's take a look at how the markets finished up 2020, a year that we'll never forget. If we take a look at the S&P 500, you can see here that we saw this peak that happened at the beginning of September, and then we saw this consolidation box taking place, with some ups and downs. But then we saw a positive breakout above that level at the beginning of November, and then a fairly straight line, of course, some squiggles along the way, as the market marched higher in November and December to finish the year at an all-time high. Now, an all-time high, you can never complain with that. There's blue sky above. There's no resistance levels as far as that goes. If you take a look here, we are seeing a little bit of a divergence on the relative strength index. Price momentum isn't quite as strong, which means that we might see a little bit of softness here, particularly as we move into the new year. But if we take a look at the trading day on the last day of the year, look at this for the S&P 500 up until just after 2 o'clock. In fact, the market was actually down up until that time. And then up it went as investors piled into the market just because they wanted to be positioned for the market for the start of the new year in equities, basically because the market is reaching an all-time high. Look at the volume just go like this, particularly in the last bar of the day. Just absolutely huge as investors piled into the market. If we take a look at the performance of the major markets last week for the U.S. and Canada, we can see here that the S&P 500 produced a gain of 1.4%. The Russell 2000, interestingly enough, which has been a strong performer up until last week, really, produced a loss of 1.5% for the week. Now, a lot of investors were expecting the small caps to actually start to really perform well towards the end of the month and into the new year, because small caps are the part of the stock market where investors are looking for tax loss selling to occur to push it down, and then it gets relieved in the last couple of days in the month, and typically, or I should say on average, the sector will actually move higher from that. But that didn't happen. And so what was taking place is investors really were focusing on being in the market, but they didn't want to take too much risk at the same time, at least in the small cap area. And if you take a look here, the S&P TSX Composite Index produced a loss of 1.08%. So it was one of the big losers for the week last year on the major markets. If we take a look at the major sectors of the S&P market in the U.S., you can see here that the big winner was the utility sector. Now, that's a surprise to a lot of people, but utility sector does have a strong seasonal period for the last couple weeks in December. Investors like to barbell their risk. So one of the areas they'll move into is the utility sector. We saw interest rates move down a little bit last week, so the utility sector benefited from that. Interestingly enough, the energy sector, which has been performing quite well recently, was the big loser in the U.S. And now the energy sector, once again, investors were expecting tax loss selling to be relieved because it is down for the year and has made some fairly large losses for the year, despite performing quite well recently. But we didn't see that uptick last week. It'll be interesting to see if it follows through. On a seasonal basis, we tend to see the energy sector, the start of the seasonal period is February 25th for the energy sector. It can start earlier. January tends to be very volatile. So it might be an early entry into the energy sector, a possibility coming up if we do see a big pullback in the energy sector before the seasonal period. Something to watch out for. If we take a look and see what's coming up in the next little while, or I should say for the next, the next couple of weeks, we can talk about the earnings. First of all, there's really not a lot of earnings this week as we're finishing off the earnings season. And we're coming up to the new earnings season, which starts unofficially on January the 15th as the U.S. big banks start to report their earnings. It's going to be interesting because last month the Federal Reserve announced that they were pulling back, they were allowing the big banks to actually buy back their stocks. And so almost immediately, JP Morgan jumped on it and said that they were going to be buying back $30 billion worth of stock. So it's going to be interesting as we head into the next quarter. If they come up with good earnings, investors might get a little bit excited about the sector. just because they now have the capability to buy back their stocks. On the economic front, the ADP number is going to be interesting, and the reason being is the non-farm payroll comes out later on in the week. So it'll be interesting to see what happens with this number and how the market reacts to it. The big news of the week will be the non-farm payroll on Friday. Only expect 100,000 jobs to be created in the month of December. And the month of December tends to be light anyhow because of the holiday season, and companies don't do a lot of hiring at that time. And with COVID, obviously, that's had an impact as well. So it's going to be interesting to see what happens with this number and how the market reacts to it. If we take a look, I want to take a look at the overall market in the month of in January and talk about what to expect, at least on a seasonal basis. If we take a look at now, first of all, I'm going to be referring to my 2021, Thackeray's 2021 Investor's Guide. It was delayed a little bit this year because of the supply chain and COVID disrupting that process. And it's interesting, actually, when you start ordering materials and producing things, and take a look and see how, although there's a lot of activity going on in certain sectors of the economy, the supply chain disruptions has just been huge. And it did affect the printing industry as well. So it's a little bit delayed, but it should be hitting the bookstores. It should have already hit them in late December. Some bookstores might begin in early January as well. But anyhow, some new stuff, some good stuff in the book, and I would like to refer to that. So I'm going to start by taking a look at January here from 1950 to 2020. You can see here on average, it tends to be one of the better months of the year. And it tends to be positive. But it used to be considered one of the best months of the year. But we have seen over the last decade or so some big down months for the S&P 500, which has been unusual. So January can be a real pivot month. If the market's moved higher, from the last quarter of the year, it can pivot downwards. And let's hope that's not the case, because the market has moved higher here. And if the market's bottomed earlier, it can actually be quite positive as well. But if we take a look at some of the gains that and losses we've made over the last few years in January, I'll refer to the Dow here. It's the top line. You got in 2014 a loss of just over 5%. Then 2015, 3.7%. 2016, 5.5%. Then we saw in 2018 a gain of 5.8%, and in 2019, 7.2%, and then last year in 2020 a loss of 1%. So it's just showing you that there's been this real, either large gains or large losses in the last little while. So it's going to be interesting to see what happens this year. And let's hope there isn't a pivot where investors question the valuation of the markets, which can happen the new year as investors take a look and reevaluate. If we take a look at the sector level, we can see here that the information technology sector tends to be one of the better performing sectors of the month. And we are in the seasonal period for the information technology sector. On average, from 1990 to 2020, it's actually produced an average gain of 2.8% and being positive 74% of the time. Actually outperformed the S&P 500 74% of the time. Consumer discretionary tends to do well. Healthcare, now it's not a really strong seasonal period, a big seasonal period for the healthcare sector, but we can see the healthcare sector actually do quite well in the month of January. Industrial is interesting, although it's the top half of the sectors as far as average performance, because these are all ranked on average performance. You can see here it's only outperformed the S&P 500 approximately 1/3 of the time. So either it's real hit and miss. It can do really well, or it can underperform. You have to be a little careful as far as some of the cyclical sectors, and including the material sector as well. But if we take a look at the industrial sector here, we can see here that since 1992 to 2019, so the full year comparison with the months, you can see here that on average it's produced a gain of 0.1%, and that's really that bar you can see here. Median is above the S&P 500, so the median gain is actually higher than the average and the S&P 500, but not by much. And once again, you can see here about 1/3 of the time it's actually outperformed the S&P 500, which means 2/3 of the time it's been underperforming the S&P 500. So a little bit tricky. Now, with the seasonal period, I've broken the industrial sector down to two seasonal periods. One's October 28th to December 31st, and the other one's from January 23rd until May 5th. And some people ask me and say, well, look, it's just a small gap. Why? Why do you have that there? And it's because the industrial sector tends to have this really weak, not all the time, but on average, a weaker performance in this period. So it makes sense from a seasonal basis to at least lighten up or consider getting out. Now, if we see strong momentum, in fact, I actually note it down here as well, as far as an alternative strategy, and talk about how you can bridge it if you do see some strong momentum taking place. And with the material sector, same type of performance. You can see here that median is actually, for the month, it's actually negative as well as the average. It underperforms the S&P 500. Only outperforms the S&P 500 40% of the time. Over the last 5 years, interestingly enough here, that you can see here that this black box, which represents the median, has been above the S&P 500, although the mean has been slightly below. So once again, those sectors tend to be a little bit sporadic as far as their performance in the first part of January. So like the industrial sector, its seasonal periods really kicks in on January 23rd. If we go back and take a look at the subsectors in the market here, we can see here that the semiconductor sector tends to be a top performing sector. The average gain in this one's from 1995, over 3%. And the home builder sector actually does quite well here as well, outperforming the S&P 500 61% of the time. Silver and gold tend to perform well relative to the S&P 500 as well. So if we take a look at silver, you can see here that, so this chart's from 1984 to 2019. You can see on average, this really is the time period on a seasonal basis where silver can do quite well. And relative to the S&P 500, we tend to see that. And that's from December 27th to February 22nd. And we can see that coming up here as well, where the bar is well above the diamond, which is the S&P 500. And the cross here as well at the same time. And over the last 5 years, that black box right here is above the diamond in January, and also as well in December as well at the same time. Positive 64% of the time in January from 1984 to 2019, and outperforming the S&P 500 in the same time period 58% of the time. So silver can actually perform quite well. If we take a look at a little more detail on silver. So I want to talk about silver as a sector, okay? And I've talked about, a lot of people will take a look at gold. And silver and gold have a similar seasonal period. So silver tends to perform well, as I mentioned here, from December 27th to February 22nd. And gold has a little shorter seasonal period, and gold miners can also perform well in the same time period. But I want to point out here, in this case here, where we are right now for silver as the sector to focus on in this presentation. If we take a look at silver, really over the last few years, and I'm going back to 2014, we've really just gone sideways up until this summer. On an absolute basis. And if you take a look in this chart here, this is silver relative to the S&P 500. Now, the reason why I'm measuring it to relative, although silver's commodity relative to the S&P 500, because it's not just a precious metal, it does have industrial properties and will move similarly to a sector of the stock market. So, and is somewhat correlated to the markets. And this graph here actually shows you the U.S. Treasury 10-year yield note as well. So when the yield's going down, and typically what you'll see is, in this case, if the yield's going down, it will usually be that silver will perform quite well. But we didn't see that back in 2014 and 2015 in that time period. This was one of the exceptions, but then we did see in 2016, we did see that downtick, and then we saw silver outperform the S&P 500. And when the interest rates were rising in 2016, 2017, and into 2018, silver was underperforming. And it's just the opportunity one of the major reasons is the 10-year yield is related to the real interest rate. And a lot of people don't follow the real interest rate. So in the short term, the real interest rate is affected by the change in the 10-year. So there is some relationship for people to follow. And if just looking at interest rates going up or down, in the short term, it also states something about the real rates as well. So if we take a look here, once again, in 2019, we saw the interest rates actually fall down. And in this case, silver actually just went sideways. On an absolute basis, it was positive. But investors really were focused on other parts of the market, i.e. the growth sector of the market as well. And then we saw in 2020, we saw this big downturn that took place for the interest rates. The Federal Reserve was forcing that to happen, and silver actually performed quite well relative to the S&P 500 and on an absolute basis as well. What we've seen here, though, is we've seen this uptick that's taken place in the interest rates, which has caused silver to underperform. But recently we started to see silver actually bounce back, and interest rates have not moved down. So that's a positive sign. It's saying that investors are very interested in the sector. When the sector is performing well without the catalyst that typically helps it move much higher, it could be a good sign. And particularly when we're at the beginning of the actual season as well. If we take a look at the seasonal period. If we take a look at this graph here, you can see it in a little more detail here. You can see here this is silver up top. You can see that it's actually pulled back down from August. And let's zoom in a little bit more. And then we start to see this bottom take place in late November, early December, and we've seen silver march higher from there. Relative to the S&P 500, you can see here that in August, we've seen silver move down, and then once again, just like it has on an absolute basis, is been outperforming the S&P 500. If we go back and take a look at the chart here, you can see here, I wanted to point this out, that we've seen bottoms in the price of silver that have taken place in the last quarter, typically towards the end of the year on an absolute basis. So you can see here in 2014, we saw the bottom take place. Now, it did actually pull back down after, but we did see some sort of bottom take place on that. And if we take a look in 2015, we saw the same thing, a pullback, and then it actually performed quite well. And then 2016, so we saw that pullback take place, and then up it went in a seasonal period. And then from there, it actually went down. And we saw once again this bump that took place, and then it was flat, and then down into the next seasonal period. And then in the seasonal period, we saw once again towards the end of the year, it went up again. And the same phenomenon taking place, it pulled back in 2019 and then rallied. It fell apart here in March as everything else fell apart. And went down, which proved to be an excellent buying opportunity. And then we've seen really what's taken place is silver's pulled back towards the end of the year. We have started to see it have an uptick, and maybe that's the uptick that we get this year. But we're still at the really beginning stages of the seasonal period, and we have a lot of positive dynamic that could take place for silver. Well, thank you very much for joining me today. I'm sure January is going to be a crazy, crazy month. In one way or the other, I'm expecting a lot of volatility to take place as investors really start to question a lot of different things in the marketplace, whether it's inflation versus deflation, whether it's this little bit of, is the market overvalued or not overvalued? This is when everybody tends to reassess backwards from last year and start to reevaluate. So we could see an uptick in volatility. We could see a lot of sectors change hands. I pointed out that silver could be one of the beneficiaries in the month. In the video, I also pointed out some of the other sectors that typically do well. So anyhow, well, thank you very much for joining me today.